Hello, everyone. We'll get started here real shortly. Just give it a minute or so. All right. Good afternoon. Thank you for joining. My name is Scott Walker. I'm the Senior Product Specialist here with Gradient Annuity Brokerage, and today our guest is Jay Rosenkrantz with Athene USA, and he will be covering some fantastic enhancements to their existing product line as well as introduce their newest 7-year FIA. Jay?
Thanks, Scott. Appreciate it, and thanks everyone for joining. As Scott mentioned, lots of content, good content to cover in the next 30 minutes or so we're going to get right to it. We're going to cover we increased the bonus and the payout factors on our go-to for income, which is our Ascent Pro bonus. We've also increased the bonus on agility to 25%. That's kind of our Swiss Army knife FIA. And then finally, as Scott mentioned, we launched a few months ago AccuMax 7, which is an accumulation vehicle, but with a few interesting twists that we think you'll like to hear about. So before we get into the products, just a couple quick notes that you may or may not have heard. Recently upgraded to A+ from S&P, so a great feather in our cap. Financials continue to be really strong, almost $3 billion in excess capital and over $8 billion in available capital currently. In addition, last year, we've for the 14 consecutive quarters, we've been the number one provider of FIAs in the independent space. But last year, we were able to overtake Allianz, who had an 11-year grip on the number one overall fixed index annuity provider. And we were able to take that position for 2020 and have kept it in the first quarter of 2021. So, and part of that was that even last year, which was a challenging year for most, fixed index annuity sales down 25% year over year. In 2020, we were able to grow last year despite everything that went on. So we do have what we think is a great lineup of products that can fit every retiree or every pre-retiree. As I mentioned, our go-to for income is the Athene Ascent, and we're going to talk about that a little bit today. Go-to for legacy is the Agility, and we're going to talk about that as well. And then our go-to for accumulation is the Performance Elite. That's our best-selling FIA, but we've also added the AccuMax, which we think is a nice complement to the Performance Elite, and we're going to talk about that as well. So kick it off with the Athene Ascent. As I mentioned, that's our go-to for guaranteed income. We actually have two choices of riders on the Ascent. Option 1 is for guaranteed income, and option 2 is for participating income. For the sake of time, we're just going to focus on option 1. As I mentioned, we recently increased the bonus to the income base to 20%, as well as increased the payout factors and increased the par rates. So we find now that Ascent is very competitive, and we're going to go through an example of exactly how competitive it is. The roll-up on Ascent is 10% each year for the first 10 years. So 20% bonus day 1, 10% roll-up up to 10 years. So here's an example of how the Ascent works. The client was 60 years old and put in 100 grand. Immediately, their benefit base would be 120,000. And then each year that they wait to take income, they're going to increase their benefit base by 10% or 10,000 a year. So if you fast forward to age 65, the income base has grown to 170,000. We then apply the payout factor at that point if they want to turn on income at 65, and the payout factor increases every year by 10 basis points as well. So obviously, the older you get, the more income you're going to receive. So a 60-year-old receiving income at 65 would get $7,310. If they waited until age 70 to take income, you see that income base would grow to $220,000. And because the payout factors increase every year, you can see that payout grows to north of $10,000 at age 70. So a couple other features on Ascent. One worth noting is that you can take 10% free withdrawals each year, including year one on the Ascent FIA. And that's noteworthy because we've actually done some research and shown that for clients that are looking for immediate income, they may actually benefit from taking withdrawals starting in year one and then for the next few years, and then delaying taking the income, turning the income rider on so that they can get the benefit of that 10% roll up. And by doing that, depending how old the client is, they can actually increase their income by anywhere from 10 to 20%. So a quick example here, let's say a client's 65 and they've got $100,000 and they need income immediately. So they could turn on the income rider immediately on Ascent. You don't have to wait to turn on income if you want. Obviously, you get that 20% bonus, but you don't get the benefit of the 10% roll-up. So if they turn on income immediately at 65, guaranteed income is $5,160. So good, but not great. Instead, what we can do is take those withdrawals, those free withdrawals that you can take starting in year one, and then turn the income rider on down the road, say 5 years later. So in this example for a 65-year-old, we figured it out that if they take withdrawals for 5 years, they can take out actually just under $5,800 in withdrawals for the first 5 years. That's a 12.3% increase over turning the income rider on immediately. And then even if they earn no interest, if they turn the income rider on at age 70, they still keep that same $57.94, and of course now they get that guaranteed for the rest of their life. If they do earn a little bit of interest, say a little over 4%, then that guaranteed income would start even higher. In this case, at $59.31. So if you reach out to the gradient marketers and are looking for a scenario of a 65-year-old turning on income immediately, the highest that comes up on their software is actually around $5,508. So the $57.94 by using this method obviously is top of industry right now. So for folks that are looking for guaranteed income, and certainly there's a lot of them out there, make sure and reach out to your marketers at Gradient. They know how to set this up. Depending on how old the client is, we'll be able to tell them what the withdrawal will be and how long they have to wait to turn on the guaranteed income rider. So here's what the illustration looks like. You can see that they're taking out the $57.94 for the first 5 years in withdrawals, and then they pivot over and turn on that guaranteed income rider after the 5th year. And you can see that at a 0% rate of return, they're still getting the same guaranteed income for the rest of their life. If in fact they get a moderate amount of return, then their guaranteed income will start higher, and then they'll get that for the rest of their life. So Ascent for guaranteed income, top of industry right now, so very excited about that. The agility, as I mentioned, it's kind of our Swiss Army knife. So strong on accumulation, it's strong on income, and it's strong on death benefit. We have a 7-year contract and a 10-year contract, and we recently increased the benefit-based bonus on the agility to 25%. So very excited about that, very competitive. And the nice thing about agility, it has liquidity just like Ascent, but it takes it one step further. So 10% free withdrawals starting in year one. However, its free withdrawals are 10% from the initial premium, whereas Ascent is 10% of the account value. So for folks that are looking for predictable cash flow, you can use the 10% free withdrawals from Agility to do that. And so a lot of folks will use Agility to fund a life insurance policy, for instance. And then we're going to go through an example of how a client can use Agility to help make an informed decision on when to turn on Social Security. So there's a benefit base on Agility, much like Ascent. The difference is the benefit base for Agility can be used for both guaranteed income. However, you have to wait to turn on the guaranteed income on Agility in either 7 years on the Agility 7 or 10 years on the Agility 10. But that benefit base can be used for either guaranteed income or as a death benefit, and all that with no fee. So let's just walk through a quick example of how the benefit base grows over time. So at issue, you get the 25% bonus, and then every year after that, we'll grow that benefit base by 175% of the interest earned in the contract. So quick example, let's say that a client puts in $100,000. Day one, their benefit base is $125,000. So unfortunately, if the client passed away in day 2 of the contract, the death benefit for the beneficiaries could actually be $125,000 if they took that benefit base over a 5-year period. If they wanted the lump sum, they get the account value, which would be $100,000. So let's say that in the first year, the client earned a 4% return. So they earned their accumulated value would go from $100,000 to $104,000. But the benefit base would grow by that $4,000 multiplied by that 175% factor. So the benefit base would actually grow by $7,000. So at the end of the first year, the account value is 104, the benefit base is 132. So again, if the client passed after the first year, beneficiaries could take that 132 in its entirety over a 5-year period, or they can take the 104 as a lump sum. And so that benefit base will continue to grow at 175% of the interest earned every year. And then when you even turn income on, we still grow that benefit base using the same 175% multiplier. So that helps to elongate the benefit base in the income phase. And then the only option in the income phase for Agility is increasing income, which is great, and again, all included for no fee. So here's an example. I mentioned before that the Agility can be used for clients looking for predictable early income by using those 10% free withdrawals of the initial premium. So as you know, a client can turn on Social Security as early as age 62, full retirement age currently 66, soon to be 67, and they max out at age 70. The client, if they wait until full retirement age, they get a 7% roll up each year. And if they wait past their full retirement age until age 70, they get an 8% roll up from years 66 to 70. So, if a client has the means to wait, they might want to think about waiting because they're going to get 76% more income at 70 versus 62. Now, unfortunately, a lot of folks turn on at 62 because they feel like they can. Not necessarily the best decision for all, but some may see that it's a good way to wait and get that extra money from the government, but they still need money in their 60s. So that's what we want to kind of address that dilemma currently. So let's say we had a client who's 62, and if they turned on Social Security at 62, they would get $20,000 a year. But they've heard that if they wait, they're going to get a lot more at age 70. So they want to wait, but they still need to take income in their 60s. So what they do is they put $200,000 into an Agility 10, and then they're going to utilize those 10% free withdrawals. So $20,000 a year, starting at age 62, running up through 69, up until the point where they can turn on Social Security. So no rider charge, You're going to take out 10% or 20,000 year one, age 62, replicating what they would have gotten from Social Security, and then they're going to take out 20,000 each year up until age 70. So as we said, Agility, you're allowed to take out 10% of the initial premium every year. So this is a great application. So we put the money into a mix of the 3 of the uncapped strategies that we have on Agility, and so over the past 10 years, those have returned just over 5%. So they put in 200,000. They took out 20,000 a year for each of the past 8 years. They took out 160, and then with that given return, their account value at age 70 is 93,000. The benefit base has grown to close to 133,000 because of that 25% bonus and the 175% interest earned every year. So now at this point, they turn on Social Security at 70. They're going to get at least $35,000 from Social Security, much more than they would have gotten if they started it at 62 at 20,000, and it could be more based on cost of living increases. So they now have the option to where they may not want to take withdrawals from the Agility, and they just want to let it grow and then pass it on to their kids. So if we use the same 5% return and fast forward to age 85, their account value at 85 is now $215,000, and the benefit base has grown to almost $345,000. So again, remember that benefit base can be used for either income or for death benefit. So in this example, if the client passed at age 85, the beneficiaries would get either $344,000 over 5 years, or they would get $214,000 as a lump sum. So in this example, we used 40% into our 2-year Apex, which is the artificial intelligence index powered by IBM Watson, 30% into our 2-year BNP, and then 30% into the 2-year NASDAQ index, all 3 of our uncapped strategies on Agility. So by taking those 20,000 a year in withdrawals out of Agility, client was able to defer and maximize their Social Security payment up to at least 35,000, which was 76% more than what they would have received at 62. And then if you include an average amount of COLA that they may have received, that number could swell to almost $44,000. So great application to use the withdrawals, the free withdrawals in Agility to help a client make an informed decision on Social Security. So here's what the illustration looks like, taking out those $20,000 free withdrawals over the first 8 years. So we talked a little bit about Ascent, our go-to for guaranteed income, about Agility, our Swiss Army knife of FIAs. We want to pivot to the AccuMax 7, which is the newest FIA that we've added to the Athene arsenal. And it's an accumulation play, but with some nice twists that we think you're going to enjoy. And one thing about the pandemic that's been good is that the U.S. savings rate has skyrocketed. One of the downsides of that is most of that money is going into money market accounts. So right now, money market accounts have swelled to $4.6 trillion. Put that in reference, if you look at from 2010 to 2018, the average number of assets in money market accounts were $2.7 trillion. And if you think about the height of the financial crisis back in 08, 09, there was $3.9 trillion in money markets then. So lots of money on the sidelines. And that money is earning virtually no yield. So if you're in a money market account and there's less than $100,000 in it, your average yield is a paltry 6 basis points. But if it's over $100,000, don't worry, it's much better. No, it's not. It's 11 basis points. So you're earning virtually no yield. To pick a 7-year FIA that has tax deferral is definitely going to outpace a money market account, certainly it's a great question to ask clients is, how much do you have in a money market account currently? Because as our friend Moshe Milevsky has said, every bit of yield counts in retirement. So you want to try to decrease that yield as much as you can. So with the AccuMax, we're looking at three things: strength, stability, and flexibility. So strength in that we have great par rates despite all the market volatility and the low interest rate environment. Stability, and this is the unique feature, all crediting rates are guaranteed for the withdrawal charge period. So what that means is you lock in your rate today, and there's never going to be any renewal rate risk. There's never going to be a bad conversation with a client stating that their rates have gone down after a year or 2 years. And then flexibility, there's actually 7 interest rate crediting strategies that a client can choose from. So we're going to hit on all 3 of those points. So as far as strength goes, a lot of you that are familiar with Athene know that we have both 1 and 2 year participation rates available. The 2 year participation rates are higher than the 1 year. And so what we've done with the AccuMax is taken that out to, we have 1 year crediting rates, and then we have 7 year crediting rates. So the chasm between 1 and 7 a lot bigger than 1 and 2, meaning that we can offer a lot higher par rates on those 7 year strategies. And as far as stability goes, as I mentioned, whatever strategy you pick at issue, whether it's a 7 year strategy, kind of set it and forget it, or a 1 year strategy where you have the ability to revisit every year, the rates that are set right now, if you buy a contract, are guaranteed for the duration of the contract, and that includes the fixed account as well. And you can put premium into both the 7 year and the 1 year, and we're going to show an example of how that would work. But certainly, a great way to apply the AccuMax is a client that's in his early 50s. He has an old 401k that he's rolled into an IRA. He's not going to touch that money until at least after 59 and a half. Great way to utilize a solution like the AccuMax 7. So 3 index options: S&P, obviously U.S. equities. Again, another AI powered by IBM Watson, but this one is a multi-asset index. So it has both bonds and commodities across U.S., Europe, and Japan. So has the kind of diversification that you're looking for outside of the U.S. And then finally, really pleased to offer the Shiller Cape Index, which has been around since 2014 on our Nexus lineup, and has just been phenomenal as far as performance. Easily the biggest selling index inside of the Nexus lineup, and really pleased to offer it on one of our national products currently. So 3 crediting methods, point to point. So we have a 7 year point to point. Also very unique, we have a 7 year annual interval sum, and we'll talk about how that works at length in a second. And then obviously we have a fixed account, and then 2 term length, either 1 year or a 7 year length. So advantages of a multi-year strategy. You can see here 7 year point to point with a 55 par rate. So that's currently what the 7 year rate is, 55%. So you're getting 55% direct access to the S&P with no fee, with no risk, and no chance that that 55% is ever going to change once you buy the contract. So very compelling story there. But you can see that we looked at the last 40 years. Basically, we started a contract in 1981 and started it every day for the next essentially 40 years to see what returns would look like. And so you can see with the 7 year point to point, max is 134%, which is about 4 times higher then a 1-year point-to-point with a 4.5% cap rate. And oh, by the way, we can't even offer a 4.5% cap rate right now. I think on PE, we're at 3.5%. The average growth on a 7-year contract is 52%, twice as high as what you'd get with an annual point-to-point of 4.5%. And then 95% of the scenarios ended up with a positive interest credit. So that's the 7-year point-to-point. Here's what we're banded the par rates, and here's what the par rates look like. I mentioned the 7-year point-to-point is 55%. The par rate on the uncapped strategy, the AI multi-asset index, is a whopping 150. On the Schiller, it's 140, and I should mention that we offer the Schiller on our asset lineup, and for no fee, which is what you're getting here for 140 basis points, it's 80%. If you want to pay a point and a half, you can buy up to 150. Here you're getting 140% par rate at no cost. The annual interval sum is 50%, and with a 10% floor, and we're going to go through an example what we think is a really unique feature there. And then there's our 1-year strategies. So 1-year par rate of 60, again guaranteed for the 7-year run, and the 1-year Schiller of 55%. The fixed account currently 1.4% on the high band, and again that's guaranteed as well for 7 years. So I mentioned the annual sum, and basically how it works is you get the par rate in up years. In down years, you can only go down as far as 10%. So you can see here in year 1, the index grew, say the S&P was up 4%. You're locked in at 50% par currently, so you get 2% the first year. Not credited to the account, it's not credited until the end of the 7th year, but essentially we're taking 7 annual snapshots, and then adding those together at the end of the 7th year. So in year 3, you see if the S&P went down 16%, the annual interval sum is capped at a 10% loss. So you're just taking those 7 snapshots and adding those together, in this case getting a 25% interest credit at the end of the 7th year. Now this is really noteworthy because obviously there's a lot of people that think the market is overheated. And if you'd have started a contract back in March of 2008, which was essentially right when the market was getting ready to get hammered, in that first year, the S&P would have been down almost 48%. But in the annual interval sum, you would have been capped at that 10% loss. Then the next year, the S&P recovered and was up 68.6%. You would have captured 50% of that, or 34.3%. Fast forward to the end of the 7th year in 2015, the annual interval sum would have netted 57% interest credited, even though you had that horrible first year. Compare that with the 7-year point-to-point, that would have only earned 30%. So almost twice as much growth from the annual interval sum. So it really shines in periods of volatility with the S&P. So I mentioned at issue, you can choose both the 1-year and the 7-year strategies. If you do choose the 7-year strategies, you're locked into those for 7 years. At the end of the first anniversary, for whatever you've picked as far as the 1-year anniversaries go, you can pick and choose between those 1-year anniversaries, whether it's the fixed or the point-to-point. At the end of the withdrawal charge period, all the strategies terminate and the funds move into the fixed strategy with a new interest rate declared each year. So we put together a piece that another way to use the AccuMax 7 is with RMDs. And obviously, you're going to take money out of the contract with RMDs. You wouldn't want to take money out of the 7-year strategies because you're not going to get any interest from those until the end of the 7th year. So we put together this guide that just shows that, for instance, if a client is 70, they have to set aside 21% money into the 1-year strategies so that they can cover their RMDs over the course of the 70s to age 72. So that's a great piece to have available. We also, like Agility, have 10% of the account value available, or I'm sorry, 10% of the initial premium available for free withdrawals each year. And then just know that the death benefit on AccuMax is what we call an interim value. So if the client was halfway through the contract, 3.5 years in, they had earned 40% interest at that point and then passed away, we would take that interest earned and multiply it by essentially the amount of time that they've been in the contract. So that would be 50%. So they would get 20% growth as a death benefit there. So this just shows a look back on the various 7-year strategies and 1-year strategies. And you can see there that obviously the uncapped have done very well, again, over time, best, average, and worst. So we write the AccuMax 7 to age 83, and it's a 7-year standard charge schedule, obviously. So the strength of the high par rates with the 7-year strategies, the stability of knowing that you never have to have a bad conversation with your client because there's no renewal rate risk. And then finally, the flexibility of having both 1- and 7-year strategies, the point-to-point, but most importantly, the annual interval sum available to you on the AccuMax 7. So if you have any questions, obviously reach out to the Gradient marketers. I'm putting the Athene sales desk number up there as well if you need assistance and you can't get a hold of Gradient for whatever reason. But with that, I appreciate the time and attention, and I'm going to turn it back over to Scott Walker.
Hey, thank you, Jay. Yes, if you're selling the top of chart guaranteed income, I would suggest looking at the withdrawal strategy with the Ascent to put side by side with what you're currently offering. I think you'll be impressed. But if you do have any questions or would like more information on any of the Athene product line, just reach out to your marketer or myself at the product desk at 800-407-4137. Thanks for attending and have a great rest of your day.